In January 2000, you could have bought $10,000 of Apple stock. Today, that would be worth about $3.8 million. That's not a typo. That's a quiet $10,000 turning into generational wealth. And by the end of this video, you'll understand exactly how it happened and why almost nobody held on long enough to see it. Here's what makes this story sting. $10,000 in 2000 wasn't crazy money. It was a used car, a wedding, a down payment on a starter condo. Plenty of regular people had it sitting in a savings account earning almost nothing. And Apple wasn't some secret. It was a public company anyone could buy with a phone call to a broker. So this isn't really a story about a stock. It's a story about time, patience, and the one force that turns a normal amount of money into a fortune if you can survive the ride. Because the ride was brutal. We'll get to that. But first, the math. Because the math is almost unbelievable. In January 2000, after adjusting for every stock split that came later, Apple shares cost you about 79 cents each. Yes, under $1. Your $10,000 buys you roughly 12,600 shares. Now, Apple didn't stay one company's worth of shares. It split its stock 5 separate times in 2000, 2005, 2014, and 2020. A stock split means your shares multiply while the price drops to match, so you end up holding far more shares than you started with. Every one of those splits is already baked into that 79-cent number. Fast forward to today. Apple trades around $297 a share. That same position, bought for $10,000, is worth roughly $3.8 million when you reinvest the dividends along the way. Let that land. That's about a 380 times return on the price alone. An annualized return around 25% a year, every year, for over 2 decades. 10 grand became $3.8 million. From a company you already knew, that you could have bought in 5 minutes. So why didn't everyone? That's where this gets interesting. Here's the part the highlight reels skip. To turn that $10,000 into $3.8 million, you had to do one almost impossible thing: not sell. For 26 years. Through some of the most terrifying drops in market history. In 2000 and 2001, the dot-com bubble burst and Apple stock got cut to pieces. In 2008, the financial crisis hit and it fell again, hard. There were stretches where Apple dropped 40%, 50%, even more. Imagine watching your $10,000 turn into $4,000 and holding anyway. Most people couldn't. They sold at the bottom, swore off stocks, and missed everything that came after. In the late 1990s, Apple was nearly bankrupt. Pundits openly said it was finished. In 1997, when asked what he'd do if he were running Apple, Dell's founder Michael Dell said, and this is a direct quote, "I'd shut it down and give the money back to the shareholders." To hold this stock, you had to ignore years of experts telling you that you were wrong. That's the real reason this return is rare. It wasn't hard to buy Apple. It was hard to keep it. This isn't about being dumb. It's about being human. Our brains are wired with something called loss aversion. Research by psychologists Kahneman and Tversky found the pain of losing money feels about twice as strong as the pleasure of gaining the same amount. So when your portfolio is bleeding, every instinct screams, make the pain stop, sell now. There's also recency bias. When a stock is falling, your brain assumes it'll keep falling forever. When it's rising, you assume the party's endless. Both feelings lie to you at the worst possible moment. And then there's the hardest one, the cost of being early. People who bought Apple in 2000 spent years looking wrong. Their friends in dot-com stocks bragged. Holding a loser while everyone doubts you is emotionally exhausting. And it's exactly what separated the millionaires from everyone else. The lesson isn't pick the next Apple. Nobody can reliably do that. The lesson is about what you do after you buy something good. Apple's an extreme example, but the principle shows up everywhere. Studies of investor behavior consistently find the same thing. The average investor underperforms the very funds they invest in. Not because the funds are bad, but because people buy high out of excitement and sell low out of fear. In 2024 alone, the average stock investor earned about 16.5%, while the S&P 500 returned around 25%. Same market. The gap was pure behavior. There's also a story Wall Street loves to tell, and while it's hard to fully verify, it stuck around because it rings true. A large brokerage reportedly went looking for its best-performing accounts and found a pattern. Many belonged to people who had died or who'd simply forgotten the account existed. No trading, no panic selling, just time doing its work. That's the uncomfortable truth. The biggest threat to your returns usually isn't the market. It's you. So what do you actually do with this? You can't go back and buy Apple in 2000. But the principles that made that fortune are completely repeatable. Here are 3. Move 1. Think in decades, not days. The Apple millionaires won by zooming out. Daily price moves are noise. Real wealth from stocks comes from holding quality assets through multiple market cycles, not from timing the perfect entry and exit. Move 2. Diversify so you can actually hold. Betting everything on one stock is how you get wiped out. Not rich. For every Apple, there are 100 companies that went to zero. A broad index fund lets you capture the market's long-term growth without betting your future on a single company surviving. Move 3. Automate, then ignore. The forgotten account wins for a reason. Set up automatic monthly investing, then stop checking it every day. The less you touch it, the better it tends to do. Boring is the strategy. The Apple story isn't you missed it. It's proof of what patience plus time can actually do. And that machine is still running, right now, for anyone willing to sit still. So let's bring it home. $10,000 in Apple in January 2000, about 79 cents a share after splits, is worth roughly $3.8 million today. A 380 times return. But the money was never the hard part. Surviving the 50% crashes, the bankruptcy headlines, and the years of looking wrong. That was the price of admission, and almost nobody paid it. You can't buy 2000 Apple, but you can copy the behavior. Think in decades, diversify, automate, and leave it alone. Now I want to hear from you. Have you ever sold something too early and watched it take off without you? Tell me what it was in the comments. I read every one. If this changed how you think about patience and money, hit like, subscribe for a new What If breakdown every week, and share it with someone who needs to hear just hold. I'll see you in the next one.